Good afternoon, everyone. Welcome to the MSMF July 2023 podcast. I'm joined today, as I usually am, by Mr. Cody Redding and Mr. Jay Peters. Gentlemen, welcome.
Thank you.
We have an interesting agenda today. We may as well call this MSMF Donnybrook, or maybe since we're not going to have any presidential debates, we're going to have a debate right here today, huh? So, gentlemen, there is a wide spectrum of opinions on what's going on in this economy, the Fed, rates, the market. And I know that you guys are not exactly 110% on the same page. So I thought we would just use this as our little forum to have a conversation about that today. Fair enough?
All right.
Perfect. All right. Well, let's start with interest rates and the Fed, right? We're hearing the potential, likely whatever it is next week, may we'll get another raise, maybe more, maybe no more after that. At some point, maybe they pull back, maybe they don't pull back. A lot of uncertainty around that. So, Jay, talk to me about where you stand on the Fed and interest rates.
Sure. So with the Fed, if you remember, we started raising interest rates March of last year. Mm-hmm. In which case the market has been pricing in what they think the Fed's going to do next based on what the Fed is talking about, based on what data is coming out. There's always kind of a nice, easy to follow. Here's what the market is expecting to happen. So if we look at that data, there's a 96% chance that the Fed's going to raise interest rates another 25 basis points here at the end of the month.
96% says who?
Says the market, the futures market.
Okay,
right. Gotcha. And then if you look further out, based on what futures are doing, it looks like the Fed's probably going to hold off on any rate hikes. And then starting in March of next year, so it'll be 2 years when they start to lower rates because by then inflation should be under control. Everything should have gone according to plan. We can start getting back to normal interest rates.
Normal. Okay, good. So that kind of falls in line with our friend Gene Goldman we heard speak last week from Cetera Investment Management, and that I know you're in that camp.
Sure.
You, my friend, are in another camp. Tell me what you think about interest rates in the Fed and why you think that my dear brother over here, Jay, is wrong.
Well, I do agree with him on the rate hike probably happening here in July.
Okay.
I think that's as far as the market outlook and what the Feds have said, and I think there's agreement on there. Mm-hmm. But I'm going to go more with what the Feds are saying that they're going to do. They've been saying since the summer 2 more rate hikes before the end of the year. So I see them doing a rate hike now, maybe doing a little pause during the rest of the summer, and then coming back and doing a rate hike before the end of the year. Is that going to be November or December? Not certain on that one, but the Feds have come out and they've been very upfront with what they're going to do, and they've usually been doing that. So I think I'm just going to go with the course of they really want to get to that 2% magic number for their inflation, and I don't think they're going to stop until they get there.
So they don't care. They're going to blindly follow what they said before. Which
they're going to. I think
there's case to be made for that.
There's going to be a separation of what we think they should do and what they're going to do based off of getting that number to 2%. I don't think they care if it's a make or break type thing. That's their role and that's their job.
They care. They don't know is what I probably. Oh, sorry. I'm showing my knickers about what I think about the Fed. Jay, any counter to that?
The Fed did say that earlier. I think it was about this time last year, right before we peaked at 9%. Right, that they were going to do a whole bunch of other rate hikes, and then they slowed them down, if you remember. Mm-hmm. So they have changed once before. We'll see.
Okay. They could change the tune, but at the end of the day, I think we got to get to that 2% number until they're happy.
All right. Well, mark your scorecards at home. You determine who you're voting with here. So let's transition to the market, right? Because, again, as we know, and I think we've talked to our clients about routinely, the rates going to have a trickle-down effect on everything. But as it relates to the stock market, Cody, there is a concern, I think, a little bit about what we call the breadth of the market. There's 7 stocks, which I can't pronounce the magnificent. Oh, I just did it. The Magnificent Seven. I did it twice. Have accounted through the end of June for 75% of the return of the market. And an article that came out from Morningstar, and I won't bother listing all the stocks, but we'll reference it. But what's your take, once we talk about rates, what's going to happen, do you think, relative to the market? And we've seen some tidy returns to this point, but...
Yeah, I think overall trend, in my opinion, is, the top 7 kind of leading the way does, when we talk about the S&P 500, certainly does have a lot of merit behind it. I'm more of a trend guy, and especially in the last month and a half or so.
You are trendy.
Yeah, I'm trendy. Especially the last month and a half, I look, is it a true recovery? And I think one piece of information to look at is, what's going on with the Russell 2000. Those are small cap stocks. Usually those are kind of laggards behind. Starting to see a little pickup in steam on that. And a month and a half ago when we looked at the top 7, if you took those out, the S&P was actually flat for the year. So now that it's only 75, you got 25% coming up from behind, I think the overall trend is that that's starting to the laggards, I guess you would say, are starting to pick up a little bit of steam. So I would have to say that a lot of opinions on both sides that, is this going to continue on? I'm going to be like Jim Cramer on Mad Money, and I'm going to push the bullhorn and say that we do continue to recover.
Plug for Cramer. Okay. All right. So you're bullish, so to speak.
I'm bullish.
Okay. I know someone who's not bullish.
Hey, I'm cautiously bullish.
So Jay, what do you think? We talked about the rates. What's going to happen? What are the opportunities, possibilities with the market going forward, given all of this?
Sure. And you already kind of alluded to one of the biggest factors that, of the 500 stocks in the S&P 500, only 7 are really leading the majority of the return, right? So that's pretty thin. In which case, you might even argue that a lot of that has just been a bounce from how low they were from last year, right? So how much of that is true recovery and how much it was just oversold from last year?
Sure.
I don't know. And then the other thing is, if you look at the S&P as a whole, most of those stocks aren't even back to their market high yet. So still have a lot of recovery there, but if you look at the Fed raising interest rates, trying to slow things down, usually it takes, let's say, 12 to 18 months to really feel the effects of the rate hike.
Right.
We're not even 18 months to the first rate hike, right? Because they've raised them so quickly. We still haven't really seen all the effects on the economy. So definitely want to keep watching what's going on. We've seen one crack start to happen with the banking system, right? They kind of came in and tried to close the door on that, which was good. But are there other cracks? Are there other things? Our friends at First Trust, Mr. Westbury over there, he actually using the 10-year Treasury at 4%. And with their models, he actually projects the S&P 500 should be fairly valued at $33.50. That's quite a bit lower than where we are today.
$33.50.
I'm not that quite pessimistic on things, but I do want to see what happens more with the interest rates staying where they are. So whether they raise them more, whether they keep them the same, I still think there's more cracks that we need to kind of get through with the stock market.
So maybe not bearish, but cubbish?
Bear cub, sure.
Although bringing up, I know you're a staunch Cardinal fan.
That's what makes me think of when you say that, yeah. But in this case, sure, I'll be cubbish.
Okay. Cody, any counter to that?
There's a lot to be said with what Jay. I think he has some merit to it. I just think the market going down in 2022 was kind of a prelude in the expectation of what could happen with the rising interest rates. And I think we're seeing recovery because I think as the data comes through, it just doesn't look as bad as maybe people thought it was going to look. So that's why I'm very optimistic. I think the U.S. economy is very resilient with it. And I think, I'm surprised, I'll tell you that, so far year to date with what the market's done. I didn't think we'd have recovery this soon. I thought it would be a little bit later this year. So I'm happy with it.
Good. Yeah.
And I don't want to give it back? Is that what you're saying?
I don't want to give it back.
Amen to that. Let's not do that. And I think, Jay, you bring up a really good point that my buddies at the Fed, everyone kind of knows what I think about them, the dizzying pace at which they raised rates it's hard to get our arms around what fallout is left from that. Now, maybe none. I find that a little hard to believe, but again,
Certainly in a situation we've never been in before.
right. I'm probably looking for a data point so I can further criticize the Fed, but I don't really need another data point. So
I am cautiously optimistic. I'm still optimistic,
Right.
But I'm just maybe a little bit more cautious than,
okay, so let's go to the third thing, right? So we talked about rates. I wouldn't say you're wildly opposed to each other, but there is some disagreement in terms of what will happen there. Some differences relative to the fallout then to the market in terms of where we are today, where we're going to end up. Let's talk about the economy, right? Because the fallout of those rates hits the market and ultimately is going to hit the economy. So, Jay, talk to me. Your thoughts, based on what your thoughts on rates in the market are. What are your thoughts relative to the economy between now and the end of the year and into next year?
Yeah, so the biggest factor we keep going back to are interest rates raising and based on reaction to inflation, right? Because the Fed, there's really two things that the Fed's looking at, right? One is the unemployment rate, crazy, historically low still, despite everything we've done. And then the other one is personal consumption expenditures, or PCE inflation, which is trending down. So that's what they want to see. They want to keep going down to 2%. So as long as that continues, they're going to keep rates kind of where they are until they see something change their mind, right? So with that, I think we're going to continue to slow down, and we're starting to see some of that. Building permits for new structures has really slowed down. Savings rates, so personal, everyday Americans, slowed down. I think this is off the top of my head, but I feel like it's like one of the worst in the last 20 years, if I remember correctly.
Yeah, it's down pretty significantly.
Credit card debt is on its way up and climbing.
They typically work in reverse. Yeah.
And that's all because of inflation. So I think it's strong now if you look at some of the measurements, but you can definitely see that things are slowing down. So that's why I'm still optimistic cautiously, because I think there's still really bright spots in the economy, but the longer we keep everything elevated, trying to slow down inflation at all costs, I think it could have an effect somewhere.
Slow down inflation at all costs, yeah, the Fed. It's transitory.
Transitory.
This one should know it's transitory.
They turned that page quickly. Oh, that's not transitory anymore.
Cody, all right, so you heard Jay. What's your take after your thoughts about rates in the market on where's this economic engine going?
Yeah, everything that Jay said is 100% true. It's data that's coming through, right? In fact, it's what we should see if it's working, right? If rates are going up, we do expect economic activity to slow down. I don't think anyone would argue that. Now, the thing that I always laugh at is a year ago, oh my gosh, we're going to be in a recession by the end of 2022. Then it was the beginning of 2023. Then it was the middle, and now it's maybe into next year. Well, at some point they're going to be right. But yeah, again, looking at trends, I do think the economy, as far as activity, is going to slow down. We're already seeing that, but it's expected. So I think the market is not going to react to that unless it's a major slowdown that we're not expecting. Will we go into a recession? My opinion is no, but I think we're going to be borderline. I think we're going to go right on that cusp over there, and we should see GDP start going down. It's the effect of rising rates. It just slows people down. It slows people's decisions. So that doesn't surprise me. The big surprise will be that if this does put us into more than a mild recession, that the market would then, I think, would have a reaction to that.
Gotcha. Okay, so clearly you're not in lockstep on rates, the market, or the economy. And you guys are knee-deep in this stuff every day as much as anyone that I know. Okay? So I guess the most important question that I have for the two of you is, I hope our clients get something out of your two perspectives, but what are they supposed to do? What do you do with all this? If you two guys who know you're not economists, but you follow more economists than I care to list out, you're familiar with this stuff, knee deep in it. If you're disagreeing, what are our clients supposed to do? Cody, I'll start with you.
Yeah, I think it's having a conversation with your advisor, and for the most part, I know we all have strategies put in place to take advantage of markets. If you have a gut feeling and you feel a little weary about it, and you took advantage of the market being down and took on more risk, it might be time to look back at your risk profile and make sure that you're still in line with what you're kind of feeling. Overall, unless you need that money in the short term, there should be money positioned for that. But I think your longer term money, again, check your risk profile, check your speed limit with that, make sure that you're driving in the right lane. And if you think you're a little bit too far on the edge or going a little bit too fast, and maybe it's time to kind of wind that down a little bit.
So get off the highway and get on the side streets.
Yeah. But overall, certainly, I'm just going to be. I'm very eternal optimist for the market, and I think the economy, especially U.S. economy, is very resilient right now.
Super, great. Jay, how about you? What do clients do?
Yeah, so I've been trying to take the contrarian to Cody there, but we agree on how to take care of your investments, right? It's
Sure.
the same thing. Manage risk, and then the other thing is, we're not market timers. We don't want to try and do that. And so things that Cody's talking about, it's taking advantage of the obvious, right? And so another one that we haven't really talked about right now is looking at different cash on the sidelines and maybe taking advantage of interest rates where they're all right now.
Sure.
Right? That's been a conversation I've had with several clients right now. Hey, I've got way too much in the bank and I don't know what to do with it, right? Is there a better something for it? And the answer is yes, a lot of times. But as far as the structuring the portfolio, I mean, it's the same as it was a month ago, same as it was 6 months ago and a year ago. It's looking at risk and making sure that our investments match that.
Perfect. Yeah, and I think you guys both hit the nail on the head in face of this uncertainty. And this is a pretty tremendous amount of uncertainty, right? This could go either way in a number with all three of these issues and some other ones. And the levers that we can pull with clients and their money and their portfolio and their financial blueprint is reevaluate risk and then make sure portfolio structure can respond to whatever happens in all these things. Right? So great job today. I'm glad nobody came across the table at each other. Nobody gave it the wrong. So
That was my favorite.
I hope everybody got something out of this. You got any questions, please reach out to us. Call any of these guys. Call me, anyone else in the office. You have the phone number. You know our emails. Please use the text line. If you feel friends or family would benefit from this, please share it with them. And we look forward to talking to you next month.